So why are prices rising? When it seems like all prices are rising from food and oil and gasoline, and you have to ask yourself, maybe you are falling. When I say you, I don't mean you. I mean, perhaps the dollar bill is falling. Everything you're measuring those price increases in dollars, that might be what's actually happening. So if you think about it, you kind of think about it like a scale. And on one hand, you have a pile of dollars. On the other hand, you have goods. And if you keep piling dollars on that scale, the value and the price of those dollars is going to decline, and the price of goods, it's going to go up. So the more we print money as a country, up go prices. So that's problem number one. Problem number two is we kind of have a supply-demand issue. On the demand side, let's just take something like the green energy revolution. So we're demanding more electricity, more electric vehicles, more batteries, more copper, more nickel, more zinc, everything that goes into these batteries. And it's a lot. But at the same time, we do not like the things that produce electricity for us. We don't like natural gas, which produces a lot of our electricity. We do not like coal. We don't want to have any more coal mines. We really don't like nuclear. We don't like mining. So we don't want to mine for the nickel and the copper that we need. So that's an issue. And if you have, that scale I talked about, dollars weighing down here, so the prices of things going up, but you're also stripping off the goods. You're making that lighter on this side because you're using more goods than you're producing, and up prices go even more. Add to that the whole inventory issue. After COVID, we found out that just-in-time inventory, which means let's not have inventory. Let's just get the supplies in just as we need them to finish our manufacturing. But what if we have delays? What if we have a pandemic? What if we can't get masks? Well, now we should bring that manufacturing back into our country, which is more expensive, so inflation goes up. We have to purchase the inventory before we sell it. That costs us financing cost. And we take a risk that the inventory might not be sold, and then we're stuck with it. That's going to work its way through and show up as higher cost. Just-in-time inventory is now just-in-case inventory. More inflation. War brings a whole nother element of inflation. If you think about it, ask yourself, what does a $20 million bridge cost? And it sounds like a trick question, but it depends on how many times you blow up the bridge. In war, a $20 million bridge blown up twice cost you $60 million. All of these things are a problem. What do we do about it? You probably should have thought about it a few years ago, but commodities, investments perhaps, buy some food and oil and gas directly. Maybe companies that produce that stuff, perhaps a little bit of gold as a hedge against the money printing. We don't know if this inflation is going to continue, so you have to be careful. You can't just barrel into this stuff. But you should be thinking about it in your portfolio as some kind of a hedge in case this gets worse. And probably one of the most important things in the next few years is just diversification. Because if we get inflation, you're going to want the commodities, you're going to want some gold. But we may not have inflation for more than a year or two, and in which case you're back to bonds and stock. So the key is diversification and flexibility. The next few years, you're going to need all of that.